In this video, I will discuss 14 options that are available to you if you're struggling to pay your mortgage. I will go over the pros and cons of each option so that you can make the best decision for you. To make it easy for you to implement, I have divided the options into two groups. The first group are 5 options that you can do yourself, and the second group are 9 options that you need outside help for. With that being said, let us start with the first group, and these are options that you can do yourself. Option number 1, reduce or cancel discretionary expenses. When struggling to make your mortgage payments, a good option is to reduce or eliminate discretionary expenses to help you free up money that you can use to put towards your mortgage. What are discretionary expenses, you might ask? These are expenses for things that you can do without. For example, your gym membership, subscriptions, club memberships. You can sell or trade in expensive vehicles for cheaper ones. You can also do the same for entertainment services, like your cable or satellite TV, your internet, and cell phone packages. You can downgrade them to get a package that costs less and has less features. The pros of reducing or eliminating discretionary expenses can help you free up more money to put towards your mortgage payments, can help you prioritize your spending and identify areas where you can cut back. It can help you become more financially disciplined and reduce unnecessary expenses. The cons of reducing or eliminating your discretionary expenses include: it may require you to give up certain luxuries or conveniences you enjoy. It may not provide enough savings to make a significant impact on your mortgage. But remember, every little bit helps. It might take time to implement and see results, and may not be a viable solution if you're already on a tight budget. Last, you might take a small loss on high-ticket items. So for example, if you tried selling a car, you might take a little bit of a loss. However, keep in mind that the benefit of the sale is that you would have lower monthly payments, which will free up more money that you could put towards your mortgage. Another option when struggling to make your mortgage payments is to get a part-time job. This can provide an additional source of income to help you pay down your mortgage and also other expenses. For example, if you work an extra 4 hours every week, that is the equivalent to getting almost a 12% raise over the year. The pros of getting an extra part-time job are: it can provide a reliable source of income to cover mortgage payments and other expenses. It can help you pay off your mortgage more quickly and reduce overall interest costs. A part-time job also helps you develop new skills and gain valuable work experience, and it only requires a small time commitment each week. Now, the cons of a part-time job are: of course, it requires you to work longer hours or sacrifice free time to make extra income. It may affect your work-life balance and personal relationships. It may not be a viable option if you have limited job opportunities or health issues, and it may not be sustainable for long periods of time. The third option to help you make your mortgage payments is to rent out a room in your house. The advantages of doing this are: again, you get additional income from your tenants to help you pay your mortgage. It is a short-term solution, so once you're caught up, if you choose not to continue renting the room, that's okay. And there's no need to sell the property because you'll be living there while you're renting it out to a tenant and getting that extra income. The cons or disadvantage of renting out a room in your house are: it may not be feasible for everyone depending on many circumstances like your family dynamics, as in how many people you already have in the house or how many bathrooms you have in the house. And of course, it will impact your privacy because you're going to have somebody else who's not a family member in the house. But keep in mind again, this is a short-term solution or short-term thing you can do. And once the mortgage stress has been reduced, if you choose not to continue renting, that's okay too. The fourth option is to downsize. That is, you sell the house you're in and buy a smaller property that costs less. The advantages are the possibility of a more affordable mortgage payment. The third advantage is the reduction in your taxes and expenses. You would have more cash flow that you could use to pay off any other expenses or add the extra money to your mortgage payments on the new property. The cons are moving costs and real estate fees could be high. And if you have an emotional attachment to your home, it might be a difficult choice to make to leave a place you have stayed in for a long time or a neighborhood that you're familiar with. The fifth option you can take on your own is to seek assistance. You may be able to get help from government programs or non-profit organizations that offer financial assistance for mortgage payments. Of course, the advantages are if you qualify, you get financial assistance on your mortgage payments, access to the non-profit programs, and most important, all of this will give you relief from mortgage stress. The cons are these assistance programs may not always be available or easy to qualify for. And last, doing this might affect your credit score. But again, it's something you should look into with your financial planner or mortgage broker. The first 5 options I just discussed are things you can do by yourself. The next options are things that you need outside help for. So let's get into them. The 6th option is debt consolidation. This is useful if you have loans or debt that are at a higher interest rate than your current mortgage. For example, a credit card loan or balance with a higher interest, or any other loans that you have, you can combine all of this into a single mortgage payment that will have an overall lower interest rate. The advantages of debt consolidation are by combining all your loans into one, you end up with just one loan that you have to make payments on, so it's easier to manage. The second is that the combined loan will have a lower interest rate than if you did the average of all the other loans when they were separate, and free up a little bit more cash. Again, depending on the interest rates of the other loans that you have, apart from your mortgage. The cons are it may lead to a longer repayment period, depending on how the new consolidated loan is structured. And also, you will incur some fees with debt consolidation. Now, what you can do beforehand is to find out how much it will cost to have your debts consolidated and weigh that over the total payments you have to make with the new loan and figure out which one costs you the least amount of money in the long run. The 7th option is refinancing. This may be an option for you to lower your monthly mortgage payments by getting a lower interest rate or extending the loan term. The pros are lower monthly payments, reduction in interest rates, and possibility of extending the loan term to give you more manageable payments each month or bi-weekly. The cons are closing costs can be expensive and it may be difficult to qualify for a new loan if your credit score is low. The 8th one is closely related to refinancing but is worth mentioning, and that is a loan modification. You may be able to negotiate a loan modification with your lender to change the terms of your existing mortgage, such as the interest rate, loan terms, or principal balance. The advantages are a change in terms of the existing mortgage, lower monthly payments, and no requirement for a new loan application. It's just a modification to your existing loan. The cons are lenders may not always agree to modifying the terms of the existing loan, and it may lead to a longer loan term. Again, like with everything else, you need to run this through with your mortgage broker or your bank to find out which situation works best for you. The 9th option is forbearance. You can check with your mortgage lender if you qualify for the forbearance program. This allows you to temporarily stop making payments on your mortgage or reduce your payments for a short period of time. The advantages of these are there are no late fees because the lender has agreed for you to do this. No foreclosure proceedings are initiated even though you're not able to make payments. And of course, you temporarily stop making payments or reduce payments, which if you're in a tight financial situation could give you a little bit of a break to help you catch up. The cons, of course, are it's not a permanent solution. So if you qualify for it, it's only for a short period of time, and interest continues to accrue even during the forbearance period. This means interest is still accumulating even though you're not making payments. The 10th option is to work out a repayment plan with your lender. You may be able to work out a repayment plan with your lender to catch up on missed payments over time. The pros, well, of course, you catch up on missed payments without a big penalty. No foreclosure proceedings are initiated, so you still get to keep your home. And of course, you would have a structured plan that would help you catch up on missed payments over time. The cons are it may lead to a longer loan term, and also it requires discipline and commitment to follow the plan. The next two options are for extreme cases where you have absolutely no way of making your payments and you're trying to come out of your existing mortgage with the least amount of damage to your finances or credit score. So the 11th option is a short sale of your property. You may consider selling your home for less than the amount owed on the mortgage with the approval of your lender. The advantages of doing this are you avoid foreclosure proceedings. This is less damaging to your credit score when compared to if you had to go through a foreclosure. There's also the possibility of forgiveness of the remaining mortgage balance after the short sale. The cons, of course, is that it requires approval from your lender. The sale price may not cover the remaining mortgage balance. And also, you still have to go and find a place to live after the house is sold. So you have to go find a place to rent, which means you have to move. The 12th option, again, which is another extreme case scenario, is the deed in lieu of foreclosure. You may be able to give your lender the deeds to your home instead of going through the foreclosure process. The advantage of doing this is that you avoid foreclosure proceedings, no need to sell the property, and possible forgiveness of the remaining mortgage balance. The cons of this are it may still negatively impact your credit score, and lenders may not always agree to a deed in lieu of foreclosure. The 13th option is if you have missed payments, that's asking your lender if you can add those missed payments to your mortgage balance. Your lender may be able to add missed payments to your mortgage balance and spread them over the remaining mortgage repayment period. The advantage of this is that no need to pay missed payments upfront. So again, they're deferred or they're spread out. This may provide temporary relief from mortgage stress, and most important, no foreclosure proceedings are initiated. The cons are it may lead to a longer loan term and interest rates continue to accrue on missed payments. So you don't get a break from the interest rates even though you miss payments. Option number 14 is a reverse mortgage. And this is for people who are over 62 years old or 65 years old, of course, depending on the rules of the country that you're in. If you're over 62 years old and you qualify, you may be able to use a reverse mortgage to access the equity in your home and use it to pay off your mortgage. The pros are if you've been in the house for a while, you would have built up equity in the house, which you can access. No monthly mortgage payments are required on your reverse mortgage, and no repayments are required until you sell the home or pass away. So it'll be your estate that will pay for it. The cons or disadvantage of a reverse mortgage are usually the interest rates and fees charged are higher than average, and your equity will decrease when you do this because you're tapping into the equity in the house. However, if you're in a cash crunch, the reverse mortgage could still help you out to pay off your mortgage and free up the burden of high monthly payments that you can't make. I want you to know that if you're struggling to make your mortgage payments, you're not alone. The recent interest rate hikes that happened over the last 2 years have made it such that many people are struggling to make their mortgage payments or meet their regular monthly expenses. I made this video to show you the options that are available if you're in that situation where you're struggling with your mortgage, so that you can take action quickly and make a decision that would help you reduce the stress of making the payments. You should weigh the pros and cons of each decision or option and involve your financial planner, mortgage broker, or bank to help you come up with a final decision that works well for you. Keep in mind that some of the options have a significant impact on your credit score or financial situation. So it is important to seek professional advice and guidance when necessary. I hope this video has been helpful. If you have any questions, feel free to leave them in the comment section below. And don't forget to subscribe so you can see more videos like this. Thank you for watching.